Thanks for tuning in to Where Do Millionaires Invest? The previous shows have shown us how the clients of some of the wealth management firms, which are the rich of India, invest across various kind of assets. Our guest today, Nitin Singh of Avendus, tells us about a very interesting aspect of private debt as well as how the ultra HNIs are investing into equities directly. Hear him on the show today.
Hi, I'm Nitin and I head Avendus Wealth Management. Avendus Wealth Management is the wealth management arm of the Avendus Group, and we focus on working with entrepreneurs and UHNIs and really helping them future-proof their portfolios. Our biggest forte lies in the fact that we can identify asset classes and opportunities ahead of time, and we've built out a very strong practice both on the private market side over the course of the last 9 or 10 years, as well as working very closely with families in terms of advising them on their overall portfolios and being ahead of the curve with regard to insights and ideas. The market has recognized this, and we are actually recognized as one of the top domestic private banks in India. I look forward to today's session where I'm going to be talking with Neeraj to give you an insight over how clients are looking at investing within these markets, right? What kind of opportunities are they looking at? And what kind of pieces do they really need to look at across the spectrum of private markets, venture debt, venture equity, public equities, etc.
So there, you heard Nitin Singh talk about why is it or what is the kind of work that they do, but he joins us on the show to tell us all about Avendus's modus operandi, if you will, and what is it that their millionaire clients are doing currently and what is it that they are advising them. Nitin, great having you on the show. Thanks for joining in.
Thank you.
So we heard about the specialization that you do, but overall, can I just start off by asking you, what do you do at Avendus? I believe you guys have an AUM of 45,000 crores, maybe 1,500 families. Tell us a bit about this practice.
Sure. So, see, Avendus, as you would know, is a diversified financial services firm. We are in fact the largest investment bank in India, not only the largest investment bank in India today, but also the largest in Asia in terms of the volume of deals. And we've built out a very core speciality over the course of the last 12 to 15 years of really working with entrepreneurs. The wealth management business was actually founded 12 years ago. And it was basically founded with the philosophy of working with entrepreneurs across the country. Of the roughly 1,700 odd customers that we have, almost 90% are entrepreneurs. Right? They're all customers who are in the typical parlance of the wealth management industry about UHNIs, which typically means that they are at least $5 million plus in terms of financial net worth. And they're typically people who are sophisticated with regard to what they want, the kind of products and opportunities that they're looking for, and the kind of financial understanding that they have. This business that we set up basically, which was set up as an adjunct to the investment bank, actually has now blossomed into a full-scale large business. We are the second largest business for Avendus today. We are in the top 5 players in the UHNI wealth management segment in India. Right? We've been awarded over the last 2 years as being the best domestic private bank in India by various forums, including Asian Private Banker, Euromoney, etc. And really, I would say that the hard work that's been put in over the last 10 to 12 years has really come to fruit over the course of the last 2 or 3 years. I think the reason for that has also been 2. One is that COVID has played a very interesting role in terms of A, financialization of savings, and B, the kind of opportunities that clients are looking for. 9 years ago, we started our private market practice. We were actually, in want of a better word, the evangelizers within the wealth management segment in terms of introducing domestic HNI capital to private markets, be it venture capital, be it private equity, be it private debt. But as you know, historically, it was always led by institutional money, similar to the revolution that we saw happen on the public market side, which is that it was led by FIIs, then you had DIs come in, and then you saw this whole retail boom happen. So we were actually the leaders in that. And that really took off to a different segment over the last 2 years. I think the other piece also is that we made a significant amount of investment in becoming a full stack wealth management platform.
Okay.
So I think both the work that we do around advisory, the fact that given our ecosystem across investment banking, across NBFC, across our asset management business, we are ahead of the curve in terms of ideas and insights. And we've got a very big focus on risk. I think that has really helped us grow. So Neeraj, interestingly, in the last 2 years, we've gone from about 23,000 crores to 45,000 crores in AUM. We've gone from about 1,000 families to 1,700 odd families. And we are the largest third-party syndicator for best-in-class private equity, venture capital and venture debt funds in India. Over the last 2 years, we've raised about 8,000 crores of risk capital just from our clients alone, which is getting deployed in the markets.
Okay.
So when clients are looking for a player who is ahead of the curve with regard to his insights, who has a sense of opportunities, right, who is also measured in terms of the risk profile, right, and has diligence and is a full platform business, I mean, they've started looking at Avendus.
Interesting. So suffice to say, you are entrenched in the UHNI community on a lot of fairly new and different offerings than the normal equity offerings that are out there as well, right? So let me try and pick some brains on that front. Can I first start off with, at the current landscape, what has been your advice, or what has been the average millionaire client's response to what the portfolio allocation should be across the various investing options available?
Yeah. So, you know, so interestingly, clients have matured over the course of the last few years, right? I was laughing that during COVID, especially over the last 12, 18 months, I mean, let's count out the last 6, 7 months, which has been turmoil, etc. But before that, you know, the only thing that didn't turn to gold in the market was gold, because everything else that you touched, whether you touched fixed income, whether you touched equity, whether you touched private equity, whether you touched venture capital, right, everything was booming. And then there was a large dose of reality that happened over the course of the last 6 or 7 months, where for a combination of factors, you know, be it macroeconomics, be it Russia, Ukraine, be it earnings, be it the general change in sentiment. I mean, we can talk about it till the time the cows come home, but it's a very different investing market today. And what I'm very surprised with this time, as compared to 2008, as compared to 2010, 12, etc., is the maturity that I've seen with regard to clients, right? The millionaire clients typically are doing, for want of a better word, are doing two things. One is that they are being very thoughtful with regard to their portfolio asset allocation, right? So you'd seen a little bit of FOMO happen over the course of the last 1 year, and therefore you'd seen a little bit of imbalance in client portfolios, you know, everywhere, because there is always a little bit of an element of greed and, you know, whatever. But this time you didn't see people go in one extreme, right? So to give you a sense, the trend in the last 1 year was that a lot of people had been loading up on direct deals in the private market space. People had loaded up on equity because it was going up. People had booked profits, etc., right? People were loading up on private debt, right? And therefore, typically that risk curve had moved because people were very optimistic about what was happening in India. I think what has happened over the last 5 or 6 months is that reality has caught up. So there are 3 or 4 things. One is that I'm a huge India bull going ahead for the next 5 years, and I believe that today is a great opportunity to basically look at 2 things. One is valuations are becoming a little bit more reasonable, right? The pain is still not out completely. I still believe that this pain will continue for the next 6 to 7 months, but I think there's some level of realism and reality coming to public markets. I think there's a great trading opportunity that's emerged in good quality fixed income, because now you're seeing AAA at a much higher spread than what you saw historically. And I think the third thing that has happened is that there is a dose of realism that's come in private markets, where from it being a seller's market, it is slowly shifting towards looking at operational excellence, looking at large quality names, looking at it being a buyer's market. And interestingly, clients are perceiving that to be the same. So clients are this time not worried. They are not reacting adversely. People are looking very seriously at portfolio allocation. People are also looking at seeing, are there mispriced opportunities that are emerging, and therefore can we go in, right? So this time I've seen a much more measured approach, both with regard to people deploying cash, both with regard to people keeping some money at the sidelines, right? As well as how they're getting back into opportunities.
Interesting. So, I heard 2 things out here. One is that you believe that there could be a good risk reward in both high quality fixed income and equities per se, even though there might be some bit of pain, and some bit of reallocation to private markets as well. So versus what may have been the case 12 months ago, is there a change in the percentage allocation? I know it will be individual for individual clients, but as an average, what is it that you believe you are telling, or your firm is telling your clients to do in portfolios?
So see, what we are telling our clients very simply is that rather than looking at it in conventional asset classes, I think it's very important to look at your portfolio in terms of 3 pieces of the portfolio. The first piece of the portfolio is a safety net, which is a portfolio which will, even if the world comes to an end, is protected, right, will give you income, will give you yield, will give you whatever, and depending upon your risk appetite, depending upon your need for liquidity, that will vary between you and me. typically that portfolio will never beat inflation, right? Because it's fill it, shut it, forget it, be safe completely. The second part, and that typically ranges anywhere between 5 to 20% of client portfolios depending upon their liquidity needs.
Okay.
The second part of the portfolio, which is where we spend all our time discussing, is typically the market-linked portfolio. And the market-linked portfolio varies across fixed income, REITs, InvITs, mutual funds, public equity, large cap, mid cap, small cap. But that's where all of us are spending the bulk of our time to say that if the market delivers a 6 or a 8 or a 10% return, how do I ensure that I'm getting a 2 or 3% alpha, right? Which is why you'll tend to work with managers, you'll tend to identify stocks, you'll tend to do whatever that you do. And that's where everyone's energy goes in, right? Okay. And the third part of the portfolio is the strategic portfolio, right? Which is a little bit more illiquid in nature, but which is typically supposed to provide you that 15, 18, 20, 25, 30% alpha, which for entrepreneurs includes both their stakes in their own companies, strategic investments, private equity, venture capital, venture debt, real estate, right? What we are telling clients is that first you have to have a thought over what your allocation between these three buckets should be. Typically what we end up telling people is that in that third bucket should anywhere be between 20 to 30% of your portfolio. If you are, let's say, a moderate to aggressive client. The second thing is that the one thing that is shaping India today is the digital revolution. And we firmly believe that over the next 10 years, the kind of value creation that's going to happen in India, right? So to give you a sense, in the last 10 years, you saw value creation of roughly about $1.5 trillion happen across the private and public markets. Even in the 10 years before that, the number was similar, maybe a little lower. Our thesis and our premise is that in the next 10 years, you'll see that being tripled, right? Both on the back of what's happening, both structurally, which essentially means that you need to have presence across these two spaces. In that, a large amount of that is going to be led through digital companies. Now, whether it's private or public doesn't matter, because a lot of these companies will go through this cycle, will become public at a point of time. But as a UHNI, as a millionaire, if you want to future-proof your portfolio, and I use this word a lot because entrepreneurs understand future-proofing their businesses, they need to understand how to future-proof their portfolios as well. If you want to future-proof your portfolio, you need to have at least 20% allocation to such businesses over a period of time. If you're at zero today, it'll take you 3 to 4 years to build out, but you must, because that is what will drive the next level of growth. The second piece that we tell clients is that perfect markets, markets are becoming more and more perfect. If you look at public equities, if you look at traded fixed income, if you look at, and it's a thing that's globally, perfect markets provide you only so much opportunity to make alpha.
True.
But you need to be exposed to that. You need to have a 60, 70% exposure to that. But it's really imperfect markets and imperfect opportunities that will provide you the opportunity to make alpha. Therefore, you need to have a blend between them. The third piece, I think, to answer your specific question is, we are bullish on large cap today. We are saying within your equity portfolio, be exposed 60, 70% to large cap. We believe that there's space over there. High quality fixed income, we believe there's a great opportunity today to fill up your portfolio with good AAA tax-free, because you've not seen these yields if you want to lock in and hold it. We are bullish on venture debt, an interesting category, because if you're saying that there is pain on the venture capital side of it, and if fundraising cycles are going to get elongated, therefore then the cost of raising venture capital is much higher than the cost of raising venture debt, and good quality companies can get in, right? So we still continue to be bullish on good quality digital venture capital and consumer venture capital themes, because we believe today that with a lot of the pain that has gone by, see, what has happened from a pricing perspective in the market is that you've basically been set back about a year. You've basically seen about a 20 to 25% decline in pricing across the market. When today, we've raised 8,000 crores, as I told you, of risk capital. Of that, only about 2,500 has got deployed. The rest, 5,500 is still sitting in dry powder to be called upon. And when I talk to fund managers, what they're telling me is two things. One is that there is greater sanity. They have pricing power. They're looking at higher quality companies. There is more and more focus on companies on operational excellence and lasting the life cycle. There will be consolidation over the course of the next 1 year, because a lot of the companies will end up consolidating into market leaders. So to be somebody sitting with cash or coming into the market today, it's a great time. Have you lost about a year of return? That's fine.
Sure.
But in a 10-year fund,
it won't matter.
It doesn't matter.
Got it.
Yeah. So I hope I was able to answer this in a meandering way.
No, but this is insightful. So Before I get into some of those specifics, because I would love to understand about venture debt, about the private markets, what are your clients coming to you for? Because I'm sure, because these are informed clients, and they have a sense a lot of times of seeing things which mere mortals cannot. Where is it that they are coming, asking you to hunt for or to get them deals that maybe you have and maybe you don't?
Okay, so there is limitless appetite today for clients for good quality private debt, right? And by private debt, now I'm going a little up the curve, where I'm talking about, you know, the companies where clients believe, where they're willing to invest behind companies which are giving 10, 11, 12, 13, 14, 15% yields, but good quality names backed by good quality players with good quality assets on the balance sheet. There is limitless appetite today for clients to want to get in. Interestingly, I was thinking that trend will change a little bit with markets coming down, but that continues to remain. And the reason for that is that fixed income is such a large portion of large client portfolios. See, when you're a multimillionaire, right, a biggest piece for you is also wealth preservation over generations, right? Whether you like it or not, 40 to 50% of your portfolio will continue to be fixed income, right? And fixed income as an asset class today has become much more complex than even equity. People don't realize it actually, but you can bucket fixed income into some 15 sub-asset classes if you want to. And there's limitless appetite for good quality, mispriced opportunities where clients are willing to take substantial bets. The second piece that I'm seeing is that clients are now invested and interested in coming, and they're asking us, saying, give us good quality equity names to buy directly, public equity names to buy directly.
Instead of a portfolio approach, individual names as well.
Instead of a portfolio, so people do both.
Got it.
So people do both.
But they are also doing this, is what I'm saying.
A lot of the large family offices, interestingly, don't come to managers any longer. They hold their own large public equity positions.
Interesting.
So when you'll go and talk to an entrepreneur, he will talk to you on funds, he'll talk to you on PMSs, he will understand everything. But on direct equity stocks, he would have built out his own portfolio. He would have his own thoughts. He would at times have one or two members in his team also who are only doing that, because their sense and the way that you put it is very acute with regard to good opportunities on public equity fixed income. On public equity direct.
Yeah.
Right. So I think that's the second piece that we are seeing. The third trend that we are seeing is now a gradual shift towards clients wanting to invest globally.
Okay.
It was a conversation point for the last 2.5 years. But you've seen LRS numbers go up slowly. The SEBI limit got breached with regard to whatever, and clients are looking at global equity opportunities today. It's still not become sizable in client portfolios. It is still, including the offshore exposure that domestic funds would also have, in most large client portfolios, it is still not more than 3, 4, 5%. I mean, that is also at the most. But there are clients who are seriously saying that we want to build it out. And not because in the olden days that I want to send my money offshore, but because I am actually looking at it as a substantial part of my asset allocation. So, and I think the fourth piece, contrary, is that whilst we've seen a decline in clients wanting to do direct deals on the private market side, because a lot of it was late stage, etc. But I think there's still a demand for good discovered portfolios and good managers where clients can see a story. So, so on the consumer side, especially on the consumer side, right, on the technology side, on the SaaS side, clients are still saying, people are taking a little bit longer for decision making, but clients are still interested. So these are I would say the 3 or 4 things that clients are coming back to us for. And I think another piece that they're coming back to is to say that, is this time to rejig the portfolio? Shall I get out of my losers and get into potential winners? I think that's happening across the board.
Very interesting. A follow-up is private placement, because I believe you guys are fairly large in that space, and private markets were a very big thing, probably still are, but at least until 3 months ago were a very big thing. What is the current situation? What is it that you are telling people, and what is the appetite or what is the foresight that some of these clients have? Because I guess in this space, the client also gives you a lot of insights, probably because they may not be, I mean, their equities, their businesses may not be listed, but they have a sense of what's happening in the private markets.
Yeah. So very interesting. So I think there's been and it's a revolution in the other way, there's been a revolution in the private markets over the last 5 or 6 months. A lot of the money that had flown in terms of hedge funds, etc., has dried up to a certain extent. right? That mad race of capital where the sellers were commanding the price has slowed down. I think there are three trends that are shaping what's happening. One is that this is going to be an era of consolidation, as I was telling you. The market leaders with good operational excellence, with good quality growth metrics, with having the right levers in place are going to become bigger. And you're going to see, so, okay, let me take a step back. So we believe that if there are 100 odd companies today that are there within a particular space, right? Typically the evolution of that is going to be that roughly about 20 to 25 of them are going to die, right? Roughly another about 40 to 50 over will go through a little bit of pain over the course of the next 1 year. But if they are able to survive and if they are able to ensure that they've built their operational matrices in a manner where they are ready for a longer fundraising cycle, right? They will deliver you the typical, 3 to 4x alpha over 10 years. So the typical 12, 14, 15, 16%. And there's still that breed of 15 or 20 names that are going to be all-out leaders. That thesis has not changed.
Okay.
That thesis has not changed. In fact, it's become even more acute. The second one is, so that's point number one. But what this market and what this scenario over the last few months has done is that it's removed the froth out of the market. The second piece that is happening is that there is now more and more focus on looking at operational matrices of these companies rather than growth matrices alone, right? Which means that there is money that will continue to flow in, but into fewer names, right? Which means that there are two things that have happened. One is a lot of clients and therefore when we are telling clients today, what we are telling clients is that in the early stage, you have to go in through funds because it's a portfolio approach. This exact thing will happen, what I told you. And there's a good opportunity today to do that. Clients are recognizing that. But as is typically the case in any cycle which turns the other way, they're taking a little bit longer in decision making.
True, of course.
Because the FOMO effect has gone away and it's a large thing, right? The second piece that is happening is that for late stage, right, it's a combination of both direct deals, right, as well as funds. More and more we are telling clients that you move from direct deals towards co-investment with funds because historically if you see, and I don't want to quote any names, but of a number of the unicorns, see the biggest problem today is finding good late stage market leadership companies at attractive valuations to take in money directly. So with the exception of an asset like NSC, which is almost a commodity, right, it's very difficult for even large HNIs to have access. Right, and you're also increasing your risk.
Sure.
So clients, I'm actually still bullish about this space. Actually, I think it's about 1 year of returns that has gone by, but it's actually in times like these that you're able to find opportunities. Because see, the great thing is that you're locking your money into vehicles which do the one thing that is the biggest enemy of value creation, which is constant activity.
Sure.
See, I always tell clients that the biggest enemy to long-term value creation in your portfolios is the fact that you want to do activity in your portfolio because you look at Bloomberg Quint every day and you'll see pricing and you'll say, oh, should I do something?
Sure.
Right? And the moment you stop that and you've invested in good quality companies and they'll accordingly give you compounding.
Got it. Okay, great. So last 1 minute on the show, and I would want to wrap up this conversation by asking you therefore that are you telling people to keep some gunpowder dry across asset classes for slightly better opportunities ahead? Or do you believe that now is the time when you can start deploying, if not completely deploy?
We have been investing at gradual dips within our portfolio. But for clients who are coming in who are completely cash today, we are typically saying a gradual deployment over the course of the next 6 months to a year across asset classes. For a lot of clients, we had created some gunpowder. We've not gone all in yet.
Okay.
We will take a period of 6 months to go all in. I think especially on the public market side, right, as well as fixed income, there is still more to play out. That is 70-80% of client portfolios. On the private market side, that thesis doesn't really hold true because it's anyways deployed over a period of time. So when a client is making a commitment today, typically he's taking about 2 years to, be it a venture debt fund, be it a venture equity fund, be it a private equity fund, anywhere from 1.5 to 3 years is a typical life cycle for him to draw down a fund. And with managers, we are seeing also that they're also being reticent and hesitant about now trying to put in large blocks of capital On day one, they're taking a little bit longer. So typically, yes, if you ask me, the answer to this is it's a gradual approach across the portfolio, right? I think, but one thing that we are doing with clients is that we are spending a lot of time today. My entire relationship manager team and my entire advisory team is only spending time doing client reviews. But what I've said is go back, review every client portfolio and tell them, take a mirror and let's see what we need to realign.
Sure.
It's a great opportunity to ensure that you get out of whatever losers into potential winners.
Got it. Lovely. This was very insightful. Nitin, thank you so much for taking the time out and being in our office today and giving us so many insights.
Thank you so much, Neeraj. Yeah, pleasure is all mine. Thank you.
Seriously, the pleasure was ours. And viewers, thanks for tuning into yet another episode of Where Do Millionaires Invest?